Hello YouTube. I really wanted to shoot this video outside today, but unfortunately it was just too windy, and nobody, including me, wants to watch a video with a bunch of wind noise in the background, so I wasn't going to subject you guys to that torture. But I am here today to talk to you about things you should consider when you're thinking about refinancing your mortgage. Just because rates are low, does that mean you should refinance? Well, maybe. It depends on where you're starting from. In other words, what is your current interest rates compared to what rates are today? There's also other factors that you need to consider. Most people think of mortgage refinancing as a sure way to take advantage of lower interest rates and therefore save money on interest cost, and this can be true, but not always. Some people consider refinancing simply to lower their monthly payment. Still others consider refinancing as a way to access extra cash by pulling out some of the equity they have in their home. Since mortgage refinancing is usually meant as a way to save money on the cost of your home payments, it's important to consider how a switch will affect your monthly payments and the lifetime cost. You should consider refinancing when interest rates are down relative to your current rate and you plan to stay in your home for the long term. Now, I'll define what long-term means in a minute. You should consider refinancing if you want to tap into the equity of your home with a cash-out refinance for home improvement projects or to pay off higher interest debt. Another reason to consider refinancing is if you need to lower your payments due to a reduction in wages or other factors. Before deciding on refinance for a potential saving benefit, I recommend you figure out how many monthly payments it will take before the monthly savings from refinancing will break even with the required closing costs. And I'm going to tell you how to do that. Let's say you currently have a 30-year mortgage at 3.8% interest with an initial balance of $200,000. Your current monthly principal and interest payments are $932. Let's also assume that you've been in this home for about 10 years. In this case, you would have paid $68,324 in interest, $43,606 towards the principal, and leaving you a balance of $156,494. If you decided to refinance and found a 20-year mortgage with an interest rate of 2.75% for that amount, your new payment would be $848, saving you $84 each month on principal and interest. Just FYI, you can get a mortgage with a variety of terms. Some people think you can only get a 15 or a 30-year mortgage, but that's not true. So just remember that when thinking about how long to refinance. Just because you can't afford a 15-year mortgage doesn't mean that you have to jump all the way up to a 30-year mortgage. Anyway, back to our example. If closing costs on your new mortgage end up costing the typical 3% of the loan balance, you would pay $4,695. So dividing that upfront cost by your monthly savings of $84 gives us a break-even time of roughly 56 months or 4.7 years. Now, if you were to resell your home before that time, then your refinance decision would have cost you more money than it saved. Now, that does not factor in appreciation because you can't count on that. Your home may actually decrease in value, so don't try to factor that in when making your decision. So in our example, long term in this case means at least 5 years. Keep in mind though that in this example we assumed you paid the closing cost up front instead of adding them to the balance. In this case, if you added the closing cost to your principal balance, your new payment would be $874 and your monthly savings would only be $58. That would make your break-even point 81 months or 6.7 years. So make sure you're using the right numbers when calculating your break-even point. If you want to pay off your mortgage earlier, you can also save money by refinancing into a shorter term. For instance, you might want to pay down your mortgage more quickly by moving from a 30-year mortgage into a 15-year mortgage. If rates have gone down far enough, you may be able to secure a similar or lower monthly payment even though you're compressing your repayment into a shorter time span. If you're in an adjustable rate mortgage or an ARM, please be aware that ARMs start changing their rates after a fixed period of several years. The most popular is probably the 5-year ARM, where rates start to change after the first 5 years. So switching to a lower fixed rate mortgage from an ARM could save you money in the long term. Now let's talk about refinancing for cash out. Cash out refinancing is a good option when rates are low and you feel comfortable with adding to your outstanding balance in exchange for immediate cash. When it's done right, a cash out can be a convenient way to obtain funds needed for major expenses like home improvements or consolidating personal debt. This is particularly helpful if you have high interest debt that will be cheaper to repay as part of your mortgage. This might also be a good option for people who are struggling with cash flow due to coronavirus. If you've lost your job or had your wages cut and you don't have the cash flow you once had, you may need some extra cash. So taking cash out from your equity in your home might be a good option in that situation. Please keep in mind though that if you refinance to take cash out and your new balance is more than 80% of the current market value of your home, your lender will more than likely require you to carry private mortgage insurance, which could add a significant amount to your monthly payment. So try to stay under that amount if possible. Taking on extra debt with your home as collateral obviously poses some risk. A cash out refinance will set you back time-wise on your repayment schedule, and if your home depreciates in value, then you might end up owing more than what your property will sell for. Just like standard refinancing, cash out comes with extra closing costs that will eat into the cash you plan to withdraw. Also, you may find that the interest rate offered for cash out refinancing run slightly higher than those for standard mortgages, but it's only a small amount, usually 0.25% or maybe less. And with rates being as low as they are currently, it may still be worth it. A cash out refinance could increase your monthly payments, which adds up in terms of interest and closing costs. By cashing out on existing equity, you increase the amount that you owe. Monthly payments could increase depending on how much you take out, the new interest rate, and the term of the loan. And transaction costs must be accounted for, in other words, the closing costs. Two other things I would like to mention about refinancing. The first is don't put yourself in a bind later by trying to squeeze into a shorter term loan. If you are trying to go from a 30-year mortgage to a 15-year mortgage and you can barely afford the monthly payments on a 15-year mortgage, you might be setting yourself up for trouble later. If your home is appreciating in value, then chances are your taxes and insurance will also be increasing over time. If these are being paid as part of your mortgage payment, that means your mortgage payments will also go up. You might be better off going with a 20, 25, or even sticking with a 30-year mortgage. You can still pay off the loan by making extra principal payments each month, but you won't be obligated to make those extra payments. If your finances get tight, you can simply make your regular payment until things improve and then go back to making extra principal payments. You won't save quite as much interest by doing it this way, but you also won't be putting yourself at risk of financial trouble due to fluctuations in your income or sharper than expected increases in your escrow payment. The other thing that I wanted to mention about refinancing is that if you are doing it simply to take advantage of lower rates as opposed to some of the other reasons I mentioned, try to do something positive with the monthly savings. Use it to pay off higher interest debt or to increase your retirement contribution. Watch my videos on debt freedom and retirement planning for more details. Let's take a quick look at what an example of that positive behavior would look like. Using our previous example where we refinanced to a lower rate and it saved us $84 a month, if we added that to our retirement investment or started a new retirement plan with an IRA that had an average return of 7% over the next 10 years, we would have almost $15,000. That would be the approximate value of a newly started IRA. If the $84 a month were added to existing contributions, the increase in value would be greater due to the value of compounding. So it's not just about the decisions you make today, but how you turn those good decisions into long-term behaviors. When you change how you think about your finances, the results can be life-changing. Please stay safe out there, and until next time, behave well.